Well, good morning, everybody. Mike's actually on spring break this week, so he's out of the office, but we're all here, and so if you need anything, feel free to call Jerry, Jeff, myself, Missy, or Tricia. We're here to help you, and I'll be doing the call today. So no pointer today. We're just going to jump right into the call, and what I thought we would do very often. And so you might wonder, why don't we? Why don't we look at it more often? And the reason really is this, that when you look out across the landscape of all the people that you could get in front of, the easiest person in the world to sell would be that person with money and no advisor. So who would that person be? Well, it's probably that guy who has a 401k, so he doesn't really need an advisor. All he's doing is putting his money into the 401k so the company will match it. He works there 40 years, and then when you kind of fast forward to the point where he's getting ready to retire, he's got $300,000-$400,000 in that 401k. He's looking around for advice, and he stumbles into your office either because of the marketing that you're doing, or maybe he knows somebody who referred you. And when you meet with that person, you're thinking, this is the best day. I mean, I've got somebody in my office who has money. They're open to advice. And best of all, I'm not competing with anybody, so again, this is the easiest person in the world to sell. The problem with that person is just that there's not enough of them. Trying to find that person is like trying to find a needle in a haystack. So what the 21-point checklist does is it takes somebody off the street who has money but has an advisor and turns them into someone with money and no advisor. In other words, we're taking somebody and turning them into the easiest person to sell. And because you all have presentations that work to sell the guy with money and no advisor, we don't, talk a lot about the implementation meeting because you all have something that works. But a lot of times when I'm talking to guys and helping them with cases, I hear them say things like, well, a lot of the people that I'm seeing aren't your typical annuity clients. And with caps as low as they are, annuities really are a tough sell right now. So what I thought we would do today is I kind of want to zero in on how you position safe investments in general and show you how doing it the right way leads to literally everyone wanting an annuity. Now, saying that there's a right way is different than saying there's just one single way to do this. And what you'll really find as we kind of go through the call is that doing it the right way means showing things in context, and that's mostly what we're going to be talking about today. How do you show things in context? And quite frankly, there are a lot of ways to do that. So this morning, I'm just going to show you a couple of ways to do that. The one thing that I want to caution you and just kind of tell you is don't call asking for a script because there isn't one. The things that I'm going to do today are kind of product specific, and caps and products and crediting strategies change way too often for us to keep up with all of that. So I'm just going to show you some of the things we use and how we put them in context, but you all have things that work. I just want to encourage you to put the things that you're doing now in context. Now that said, if you do need help putting together a presentation, or you do need help putting together some sort of a strategy to take into that implementation meeting, any of the Jeffs can help you. So I can help you. Jeff Van Grinsven at ECA can help you. A lot of times if you call me for help, I might even conference in Jeff Van Grinsven. So we're here to help you. That's what we're here to do. So even though there might not be a script for any particular product or any particular strategy, we'll help you put together a strategy and we'll find the product that works. Okay? And it's a good time to go over this because with everything that's happened in the last 5 years, we've had market crashes, we've had upside down interest rates, we've had kind of an explosion in the number of money managers who work with the average investor. And because of all of those things that have been going on pretty much simultaneously, more and more people are out there looking for advice. So there's more opportunity now than there has been in the last several years. And that's if you're marketing. Otherwise, your opportunity is the same as it's always been. But because of those things, the time is really right for getting in front of people and showing them these strategies. And actually annuities are breaking records for sales both this year, well, 2013 and 2012. So it's a great time to be out there because people are looking for safe places and safe things to do. Things with less volatility and more guarantees. But caps are low, so what do? Well, you can't rely on annuities to sell themselves. And you have to be more thoughtful about how you position annuities and bring them up. So basically what we're going to talk about is 3 things have to happen for people to look at buying an annuity. And you have to get better at getting people to discuss today's risks. So you have to get better at getting an agreement about investment weighting. And we've talked about that. The last time I did the call, we talked about how in the disclosure meeting, when we talk about investment weighting, I want them to give me a number. And then you have to be better at showing context. So in short, what that means is that everyone you meet with will have to agree to these 3 things. They'll have to agree that we can't have all our money in the market. We have to have some of our money in safe things. And in today's world, the conventional safe investments have significant problems. And that third point, that in today's world, the conventional safe investments have significant problems, is what I mean by showing things in context. And if a client agrees with those 3 things, they will move some money into an annuity, even with caps this low. So I think that bears repeating. Everyone, and I mean everyone, who agrees to those 3 things will move some money into an annuity. And the income riders are an important part of positioning an annuity these days, and a lot of times that'll be the core of any presentation that you make with caps the way they are right now. And caps are typically sitting right at about 3.5–4% right now for indexed annuities. That would be kind of typical. That would be kind of average. So let's look at a couple of examples to see how this would work in real life, how this works in action. And so these are actual cases that were closed within the last year. So you're actually looking at real-world examples. So let's just dive in and take a look at example 1. So we're looking at a couple, age 65, with $1.5 million of investable assets, movable assets, and income from pension and Social Security of $60,000 per year, of which they spend $50,000 on living expenses. So they've got a lot of money. They're bringing in more from their pension and Social Security than they're spending. And so the question is, would this couple be excited about an annuity with a 4% cap? And do they need income? I mean, if we're going to pitch income riders, do they really need income? But they actually ended up putting $252,000 in an annuity. And so what we're going to look at is why. Well, first and foremost, they agreed at the disclosure meeting that they can't have all their money in the market because of the risk they would be taking. They also had bond funds, and they agreed that bond funds had risks as well, and in some ways were just as risky with interest rates as low as they are as stocks. And they agreed that they would have to dial back their investments in equities to get back in balance to protect them from market volatility. So they said they have to have some money in safe things. And they also agreed that conventional safe investments have significant problems. That's showing a solution in context, which is really the key to everything. So when we talked to this couple, we pointed out and started the conversation by saying you have $60,000 per year in income from your pension and Social Security. But let me ask you this. What happens if you die? So kind of breaking role play for a second, most pensions that you run into are not going to be 100% to the survivor. The vast majority of pensions that you run into are going to be 50% to the survivor. So when you ask people what happens to that pension if you die, they're going to tell you, well, it's going to be cut in half. And we've talked a lot about this. What happens to the Social Security? I mean, does the survivor get to keep both benefits? And we all know the answer to that is no. They get to keep the higher benefit, but they still lose a check. So they're getting double whammy. The pension goes down by half, and they lose a Social Security check. So we asked them, would it make sense to look at some things that would replace that income? And everyone says, yeah, I mean, it would make sense to do that. And then we always ask, and why? Why would it make sense to look at that? Well, because if our income got cut in half, I mean, we're not really in a position to cut our spending in half. So let me show you a couple of things that my clients in similar situations are doing. So most of them tell me they want to grow their money the best that they can, and then if they ever need income down the road, to send them interest. Now, why don't they want me to send them principal? And people will say, well, we don't want to run out. Or, you know, maybe if they're in the same position that these folks are in, you know, they just want to make sure that they can preserve it for their kids or their grandkids, if at all possible. So grow their money. They ask me, grow their money as best I can. And then if they need money down the road, send them the interest. So what are your thoughts when you hear a goal like that? And I want them to tell me in their own words what they think of something like that. Yeah, we think that's a great idea. And why? Well, because you're keeping your money, you're only spending your interest, so you always have that other money to pass on to the kids or the grandkids or for emergencies if you ever need it. So then I ask, well, how much risk do you think people should take with their house payment? And people always say, well, no, I don't think they should take any risk with their house payment. And so I say, and so because we could be potentially talking about using this chunk of money for something like that, how much risk should we take? Well, not a lot. Now, we don't want to take a lot of risks, but let me ask you this. What are safe things paying these days? I mean, what does a CD pay? Nothing. What does a 10-year Treasury pay? Any idea? No, not really. Right now, a 10-year Treasury is running right at about 1.5%. And again, what are the problems we discovered with bonds anyway? Well, that when interest rates go up, the value of them are going to go down. And so if our strategy was to grow the money the best that we could in something safe, that would be our growth rates. The 1% CD, the 1.5% Treasury, not very exciting, right? But there's still a need. There's still a need for that kind of a strategy. The challenge is that it just doesn't work well in this environment. But there are a couple of ways that it does still work, and so would you like to take a look at that? And everybody says, yeah, we'd love to take a look at that. Okay? So here's what I want to take a look at, and I would normally do this on a yellow pad, but I'm going to do it on the whiteboard so you all can see it. So can you all, Missy, can you guys see that?
Yep,
that
sure can.
Whiteboard? So
yep,
normally, again, guys, this is something you would do on a yellow pad, but I'm doing it on the whiteboard. So I draw this T across the yellow pad. Okay, so what we're going to be talking about is hybrid investment, where the upside is tied to the S&P 500, but there are no losses. So if the market lost 10 or 15%, so let's just say the market were to fall 10%, 15%. By the way, have we ever seen that? Yeah, we've seen that. Yeah, you wouldn't lose anything, because normally the market does what? It goes up, down, up, down, up, down, up, down, up, down. But in this case, if the market were to fall 10 to 15%, you wouldn't lose anything. Okay, so if they're going to limit your losses on the downside, what do you suppose they're going to do on the upside? I guess I'm not sure, but it sounds like they might limit the upside as well. Yeah, they would. And so if the market made 6 or 7%, you might only make 4%. Not terribly exciting, but not awful either. Kind of what you would expect in this environment. And because you can't lose money, you'll always at least get back what you put in plus any growth. So again, if the market did go up 6, 7%, you'd get 4. Again, not very exciting, but kind of what you'd expect in this environment. And then if the market ever fell, you wouldn't lose anything. And if the market went up, you'd go up again. Now again, can't lose any money, so you're at least guaranteed to get back what you put in plus whatever kind of growth that we can get in the years that the market's up. Okay, so you need to be mindful that, again, there are some upside limits and there are also some liquidity limitations. You can't get all your money out. Yeah, you can always get all your money out.
You can always get all your money out. Not always.
I'm getting some feedback. You can always get all your money out, but you may not be able to get it out all at once necessarily. So if you were going to use this money in the next 6 months to buy a boat, guess what I would tell you? Yeah, not that this might not be for you. So that's the one side of the diagram, and I call that side the accumulation side. Now the other thing you need to be aware is that this investment has a fee of 85 basis points. And when it comes to fees, you should only pay a fee if you what? And this is a conversation that we're going to kind of harken back to that disclosure meeting, and they'll say, well, only if you get something for it. Right, when we looked at the fees that you're currently paying, again, this is looking at it in context, because they're paying fees now. So I want them to remember that, yes, we have this 85 basis point fee, but at least with this fee, you get something for it, and compared to the fees that you're paying now, it's not going to look so bad. So I'm going to remind them, we're only willing to pay fees if we what? Get something for it. And when we looked at the fees that you're currently paying, did you always know what you were getting? No, we didn't. So you get something for this fee, and I think it's something valuable. And what it is the other side of the T, the other side of the diagram. So what they'll do is they'll track an income account. Okay? And the income account really gives us the option of creating a lifetime pension if and when we ever decide to do that. Now the great thing is we don't have to make that decision now. We can make it sometime in the future or any time in the future. We're just giving ourselves the option of choosing a guaranteed income. So with the income account, let's say you start with $100,000, just as an example. And you're putting that into this hybrid product. Now what the company will do is add 8% as a bonus to that value, so that you'll actually start with $108,000 on that side of the T. And then what the company will do is guarantee this income side to grow by 6.5% each and every year. And why do I write 6.5% all these times? Just to make a point that it's each and every year. And so let me ask you this. Where else can you get a 6.5% growth rate guaranteed every year? Well, nowhere that we know. And is that a good growth rate? Yeah, I think that's a great growth rate. And it's guaranteed. Now, when we looked at the investments that we were going to leave in the market, there are some good investments in those growth assets that you have. And we expect them to do well over time. But is any of that guaranteed? No, none of that's guaranteed. And if our strategy is to grow what you have the best we can using something safe, is this a good growth rate for something safe? Yeah, this is a great growth rate for something safe. Now this investment is offered by an insurance company, and that's why it's so safe. It's called an equity indexed annuity or a fixed indexed annuity with an income rider. Now, have you ever heard about these kinds of annuities or annuities in general before? Now, why do I ask that? Because at this point, I've been calling it a hybrid investment, getting them excited about the concept, but at some point, they're going to need to know that it's an annuity. And if they have any aversion or any objections to an annuity, I want to know and be able to deal with it right now. I don't want to talk about this thing and then get down to the point where we're filling out paperwork only to find out that that's the first time that they hear that it's an annuity, only to find out that they have some objection to an annuity. So I want to offer that fact early in the process after we've kind of talked about the concept so that if they do have any objections, I'll be able to deal with them then. Now, if they don't have any objections, if they say something like, well, no, we haven't heard of that kind of an annuity, or no, we haven't really heard much about annuities in general, do I need to deal with anything? No. I don't need to deal with anything. Or if they say, yeah, our friends have an annuity and they're really happy with it and they really like it, it was something that was sort of on our radar anyway, do I need to address it or spend any more time on it then? No, I don't. Only if they have a problem with annuities, only if they tell me that they've heard bad things about annuities will I deal with that at this point right here. Okay, so if they have a problem with an annuity, I'll find out about it right now and I'll deal with it right now so that we get that out of the way. And I have several ways, depending on what they come up with, of dealing with it, but for now I just want you to know that this is where I would ask and this is where I would deal with it. Now supposing, just for now, that they don't have a problem with it, that they haven't heard a lot, and they don't know a lot about them, they don't have an opinion one way or the other, then I'll be able to move on. And we'll be able to say, now the income side, this grows at that guaranteed 6.5% interest rate. And whenever you want, whether it's a year from now or 7 years from now or 11 years from now, you have the option of turning on the income. So remember, my clients ask me to grow the money the best I can, and then when they need the income, to send them the interest. So then the question becomes, what kinds of payouts do they have? Because they have great growth rates, right? But if we're going to be sending people the interest, we can grow your money efficiently over here with something safe and something that's guaranteed. But if at the point that you want to convert this to income, you want them to send you whatever the interest is that they're earning, we need to know, well, what will the interest be at that point? So should we take a look at that? And they'll always say, yeah, we ought to take a look at that. Because remember, you don't need the income now. And we're not doing this because you need income now. Again, we're doing it because if you die, your pension does what? Well, it gets cut in half. And your Social Security will do what? Well, one of the checks will go away. And so this income is to replace those things in the future. And again, one of the things we like about this concept is the flexibility to choose when you turn on the income, because you don't know when you're going to die, do you? No, we don't. And we may need or want the money before that, right? Right. So let me show you a chart that gives you an idea of what kind of payouts they have or what you could expect if and when you decide to turn on the income. So let's take a look at that. So then I'll just show them a chart for whatever product that we're looking at that shows them the payouts. Okay, so if you were to start the income, you're 65 now, and if you were to start it, say, 5-6 years from now when you're 70, 71 years old, you would be looking at about a 5% payout or interest rate. Is that a good withdrawal rate? Yeah, I think that's a really good withdrawal rate. So this is an idea that may not make sense for all of your money, but do you think it makes sense for part of your money? And everybody says, well, yeah, I think it makes sense for some of my money. Now, why are they so confident that it makes sense for part of their money? Because, again, remember, they agreed that, well, we can't have all our money in the market. Why? Because it's too risky. There's too much volatility, too much chance of loss. And they also said, so we have to kind of move some money to safe things. But when we look at safe things like CDs and bonds, they don't pay very good. And if we were to just withdraw the interest from things like that, we wouldn't get paid very much either because the interest rates are so bad. So this 6.5% growth rate looks awesome. That's way better than anything I could get in a CD or a bond. And it doesn't have the problems that bonds have. And that 5% withdrawal rate, that's awesome. That's better than I could get anywhere else that I could put my money that's safe. So this, in comparison, looks like the best solution. That's the conclusion that they come to. So then the question becomes, well, how much money should we put into this? If we know we have to keep some of our money safe and we want to put it into something that has guarantees and no volatility, and this is really the best thing out there. It's better than a CD because it has the opportunity to earn more growth. It's better than a bond because it has higher payouts than current bonds, and it doesn't have any of the problems with bonds with interest rates go up. How much money do we put into something like this? So I remind them, remember, our goal was to replace your lost pension and Social Security when you die. So we could be looking at replacing $30,000. And then I would just back into that number. They came to the conclusion, and we, looking at the product and that 6.5% growth rate and that 8% bonus and that 5% payout, Jeff Van Grinsven was able to calculate if they put $252,000 into this, they'll be able to get $30,000 for life guaranteed anytime they turn this on in the next 5 years. So that's perfect for them.
Hey, Jeff?
Yes.
I just had a couple of questions come in.
Sure.
On the income side, if you're returning 6.5% interest only, they expect at least their principal return to heirs. There may not be any money left in the income account.
Yeah. Well, there will always be money in the income account. The income account, remember, you mean in the accumulation side. You're right. If you start taking payouts, there may come a time, depending on how long you live. Well, let me hear the question again because it may not be an issue.
Okay, so it just says, in income side, if you're returning 6.5% interest only, they expect at least their principal returned to heirs. There may not be any money left in income account.
Okay, here let me make sure I understand the question, and they may retype it in. I think what you're saying is, if they grow this and at some point they start taking their money out at $30,000 per year to replace their pension or their Social Security sometime in the future, depending on how long they live, they may be spending down their money to the point where in the accumulation account they might not have anything left inside of it. And so that's the question, that's the issue that I'm going to address right now, and if hopefully I understand it right. So here's what I would say to that. Number one, remember, they have $1.5 million. And so we put $252,000 into that. And we're not using, that leaves $1,250,000. That's not going into this product. So is that money that they think they'd be able to leave to their kids? Yeah. Is that money that they're ever going to have to touch? Probably not. Why? Well, because their income is guaranteed. By setting aside the $252,000, the income is guaranteed. So they'll be leaving their heirs more than $1.5 million in all likelihood. Now, could they spend down at $30,000 a year all of the $252,000 that they put into the account? Yeah, they could. Absolutely they could. What's the likelihood of that happening? Well, it's high if they live to be 100. It's very, very low if they live to be 85. So depending on when they die, I suppose that could happen. But I would ask people, if you live to be 100, that's how many years? You're 65 now, and you live to be 100. That would be how many years? 35. And so if you took $30,000 from $252,000 for 20, 25, 30, 35 years, eventually what's going to happen? Well, that's money's going to run out. Right. But the company will still pay you. And whatever you haven't taken out, they'll give to your kids. Now, if you had 30,000, again, it's about showing it in context. If we could put the 252,000 into a CD, but if you put $252,000 into a CD, what's the CD going to pay? Well, maybe 1%. And if you took $30,000 out of a CD for 20, 25, 30 years, is that going to run out? Yeah, it's going to run out. So how about a bond? If you put it into a 5-year treasury and just kept renewing the 5-year treasuries, what would that pay? About 1.5%? Yeah, better than a CD, but not much better. And really, when we looked at bonds, were they any safer than stocks? No, not really. In fact, was this a good time to have bonds with interest rates as low as they are? No. Why not? Because if interest rates do go up, what's going to happen to this? It's going to go down. And if you took $30,000 out of that bond, if you put $250,000 into the bond and took $30,000 out for 20, 25, 30 years, what would eventually happen? Well, that money would be gone. So the thing I want them to understand is this perfect? No, it's not perfect. Is it better than a CD? Yeah, it's better than a CD. Is it better than a bond? Yeah, it's better than a bond. Do you know anything else that's safe that has a 6.5% growth rate? No, I don't know anything that's safe that has a 6.5% growth rate. Do you know anything that's safe that has a 5% withdrawal rate? No, I don't know anything that's safe that has a 5% withdrawal rate. And do you know anything else that will guarantee that income for life, even if you live a really, really long time? No, I don't know anything else that, so of all the things that are out there, what do you think we should do? I think this looks the best. Yeah. Could they spend the accumulation down to 0? Yeah. Will they if they live to be 110? Yes. But is that any different than what would have happened if they'd lived to 110 with a CD or a bond? In fact, they're better off if they lived to be 110 having it here, because they would have run out long before that with a CD or a bond. And we're not even talking 110. They're better off here if they live to be 100. They're better off here if they live to be 95.
And Jeff, there's a clarification that just came in. I think what it was you told them that they were withdrawing only interest, is Brahma's point. And he said, you know, the statement is actually not that you're withdrawing interest. It's actually not just the interest. So you're not going to have that.
Yep, you're absolutely right.
So.
Yep, you're absolutely right. The goal is, right, the goal is to grow the money the best we can, but what's the problem in this environment with safe things? Can't really do it. And then just spend the interest. That's the goal. But the reality is there anything out there that you can do that with? No. Why not? Because interest rates are so low that we can't grow it. And spending interest wouldn't give us enough income. I mean, if we were only going to spend 1% of the growth rate, so what's the next best thing? So I see what you're saying, Brahma. And actually, I guess a point of clarification would be that would be ideal. So we want to get as close to that as we can. So can we get close to that with a CD? No. Can we get close to that with a bond? No. Are we going to achieve that with this? No. But where are we going to be better off, and where are we going to get closest? This. And that's really the point, guys, because a lot of times when I hear people trying to sell annuities or pitch annuities to clients, what they're trying to say is the annuity has no flaws. The annuity is perfect. Now remember, this was a person, this wasn't your typical example. Would somebody with $1.5 million, what would somebody with $1.5 million think? Well, I don't need an annuity because I have $1.5 million. I don't really need income. I have a good pension. We have Social Security. We're not worried about income right now. We have $1.5 million. So even if we did lose our pension and our Social Security, we could just tap into our $1.5 million and make up the difference, and we'd probably still be okay. Is that true? Yeah, guys, absolutely that's true. And so a lot of guys would look at that and say, well, they're not going to be interested in an annuity. But I'm not talking hypothetical. They did put $252,000 into an annuity. So the question becomes, why would somebody like that put money into an annuity? Because they thought the annuity was the be-all, end-all and didn't have any flaws, it was the perfect investment? No. But they knew, looking around at everything else that they could be putting their money in, that this was the best alternative and it was going to get them closest to what it is they were trying to do. And that's ultimately how it, and like I said, you don't have to use this presentation, use your own, but put things in context. Because if you don't, you're right, somebody like this will look at it and say no need to have any money in an annuity, and you're walking away from a $250,000 deal. And not only are you walking away from a $252,000 deal, you're walking away from an easy $252,000 deal. This isn't even hard. Why isn't it hard? Because four things really. One, they have money and they don't have an advisor. So they're open to your advice. That's number one. Number two, they agreed and told you in their own words, we can't have all of our money in the market. Number three, they told you in their own words, we need to have some money safe. And number four, this is about them. We're really zeroing in on number four and wondering how do we get people to say in their own words, this is really the best safe thing that's out there. All safe things have problems. But this is the safest thing with the least problems and gets us closest to our goal than any of the other safe things. It's got a better growth rate, it's got a better payout rate, and the income is guaranteed for life. Yeah, it would be great if we could spend all that money and not have to worry about maybe living a really long time and spending it down and having to leave our heirs a little bit less, but in the grand scheme of things, knowing that we'll never have to tap into those other assets, this makes the most sense. So build that presentation, tweak it, convert it, adapt it however you want. This is the American Equity Retirement Gold. If you're going to sell Allianz 222, talk to Jeff, talk to myself. We'll show you how to adapt it to what you're doing. And we'll show you how to adapt it to the particular client you're seeing. Again, we just want you to see that putting it in context gets even your atypical person to say, yeah, we need a chunk of money in that. Other questions?
Yep, I do have a couple other questions here, Jeff. This is a good one. Couldn't you pull out more to create more income and buy a second-to-die GUL life policy in order to replace that money?
You can talk to Jeff and you can talk to me. There are all kinds of things that you can do. Remember when we started out this call, I said this isn't the only thing you could do. And the reason that we weren't going to put a script out there is because are these the only options? No. Absolutely, there are a lot of other options. And so if you're wondering how would that other option work, absolutely. Call me, call Jeff, tell us what the client has, tell us what the situation is. Yeah, all of those things can work. The key is showing it in context. Because if you don't show it in context, what they'll say is, I don't want an annuity. Or I'm not into life insurance. I'm not keen on life insurance. And they're not going to say that if you show it in context. Yeah, a lot of things will work. But if you don't show them in context, nothing will work. Another question?
And another question was, what is the rule of thumb for showing a joint payout over a single? You know, when would you actually ever show a single payout?
You know, just on the fly, I can't think of a time that the married couple that I would be showing a single payout necessarily. I'd be leaning towards a joint. If you can't get the income that you need, then we might be looking at something like that. But again, So much goes into it, the age, if the husband's so much older than the wife, or the wife is so much older than the husband, or those kinds of things are individual things that we can look at. And so I can't, not knowing the age of the people, the amount of assets, and what kind of income they're trying to cover, that would be a really difficult question to just answer without any context. And that's why I say, we don't spend a lot of time talking about the solutions meeting, because there's no general rule of thumb, I think, that works for everybody in every situation. Not all clients, not all income levels, and not all advisors. But we can put something together that would work, and we can craft something that puts it in context so that the likelihood that they're going to buy is practically 100. And again, I say it's practically 100 because, again, we're talking about somebody who has money and no advisor. If they had an advisor, would you have trouble? Yeah, you'd have trouble. If you didn't put it in context, would you have trouble? Yeah, you'd have trouble. So it's so important. We talked in the past about the importance of the 21-point checklist and getting that other advisor out of the picture, because that makes it a near certainty that they're going to do something with you. Doesn't mean they're going to do an annuity with you, but they're going to do something with you if you get that other advisor out of the picture. Now, if you get that other advisor out of the picture and then you show annuities in context of all the other things that are out there, they're going to do not only something with you, but they're going to do some annuity work with you too, or some insurance work with you if you decide to go the IUL route. So the 21-point checklist is designed to get them to leave their current advisor so that they'll do something with you guaranteed. What the implementation meeting is designed to do is to show things in context so that not only will they do something with you, but they'll also do a balanced plan with you. They'll put their growth money in the market, but they'll put their safe money where you tell them, well, not even where you tell them, where they tell you is the best place for it right now, given interest rates. And right now, the best place for it, given interest rates, is probably an annuity. It's probably not a CD, and it's definitely not a bond. And when we look at all the other ways that we could keep our money safe, this one, while not perfect, is looking the best. Any other questions?
Another one came in that says, people are jazzed about their market returns last year. What's your favorite phrasing to draw attention to market risk?
Well, when we talk, that's in the disclosure meeting, I'm really going to spend a lot of time talking about the two risks that people have. And that we may not have enough time on this call to go through that. There's not one phrase because, again, we don't tell you what to say to convince people to move their money. I don't have a magic phrase that people hear and think, wow, that really sticks with me. What I have are questions that I ask people so that they come to their own conclusion. And so I'll ask people, given the fact that we have to worry about inflation, because over time, what happens to our spending power? It goes down. Why? Because of inflation. Right, so we need to grow our money to stay ahead of what? Inflation. Otherwise, what happens? Well, we'll lose our spending power as we age. Right. So why don't we put all of our money in the market? Well, because that's kind of risky. Nor are we going to put it all in the bank, because we could avoid all the volatility and all the risk. But why wouldn't we do that? Why wouldn't we put it all in the bank? Because it doesn't earn anything. So you have to be a little bit worried about both, and how concerned you are about one versus the other kind of depends on where you are in life. And then I give the example of the two extremes. A 5-year-old isn't worried at all about volatility. Why? Well, because her parents pay for everything anyway. But she is worried about, or he or she is worried about, what a house is going to cost 30 years from now when they go to buy one, what gas is going to cost, what groceries are going to cost. So they're not worried about volatility, they're worried about what? Inflation. But the 95-year-old, is the 95-year-old worried about inflation? No, she jokes that she doesn't even buy green bananas. Why isn't she worried about inflation? Because she's not going to be living that long. And that's why if you go to these retirement communities, you see a bank on every corner, because what are the 95-year-olds putting all their money in? CDs. Right, so they're not worried about inflation, but they are worried about what? Volatility. Because if they lose money, how much time do they have to make it back? Well, hardly any at all. So we could put all our money in either extreme. We could put it all in the bank, but we're not going to do that because why? Well, we won't be able to grow it. And we're not going to put it all in the market because why? Well, because, that would be silly. That would be ridiculous. We'd lose too much. Too much at risk. So I understand people are happy. Did these people with $1.5 million want to move everything to an annuity? No. Did we suggest that they move everything to an annuity? No. Did they put half their money in an annuity? No. But they put $252,000 in an annuity. Why? Because they said we can't have everything at risk. I'll use that in the investment weighting part. A lot of times we'll use that bell curve. We'll talk about how everything in life works on a bell curve. So if we had 165-year-olds running in a race, 10% of them would finish really fast. That's there on the bell curve. 10% of them would finish really slow. That's, you can't see that, back there in the bell curve. And then everybody else would finish in this herd somewhere where? In the middle. So investing is a lot like that. 10% of the people are really, really fast, so their idea of investing would be to take their check down to the Indian casino and play blackjack, because you can double your paycheck in just a couple hours playing blackjack, right? Those are the really, really fast investors. 10% of the people are really, really slow investors. Their idea of investing is taking their money and putting it in the mattress and burying the mattress in the backyard. Now, I make the extremes sound ridiculous. But where are most people? Well, they're in the middle, right? And so where do you kind of see yourself? And what do they always say? In the middle. So what are they starting to tell you? We shouldn't have all our money in the market. Should they be happy with the returns that they've gotten over the last few years? Yeah, they should be ecstatic. But even those people are going to tell you, we're not here, we're here. And that means we're not going to have all our money in the market. We're going to have some safe. If they decide that they're going to have some safe, you're off to the races. Because then we're just going to look at safe things, and what are they going to conclude? The best safe things, of all the safe things that are out there, the best one is this. Any other questions?
Jeff, in this example, aren't you replacing income when one dies? So kind of going back to that single versus joint. So should it show as single then in this particular example?
It could. I suppose it could. But again, it depends on the case. Am I requiring them to wait until they die, or did I tell them they had flexibility to take it while they were living too? They have flexibility to take it while they're living. I said, you don't know when you're going to die, do you? No. So you need some flexibility. And besides that, you may want or need it before that, right? So I suppose you could do single. Again, I don't want to split hairs on whether it should be single or joint. I picked joint because it gives them more flexibility, and I thought flexibility might be a selling point. But we can look at each individual case and each individual client and customize something for each person. But that's not the purpose of today's call. Because if I was going to show, like we started out by saying, why wouldn't I put a script out there? Because some people are going to want to use IUL. Is that okay? Yeah, that's okay. Is everybody going to use retirement gold? No. Is that okay? Yeah, that's okay. Are some people going to be dealing with people with $1.5 million in assets and others with 300,000 or 400,000? Yeah. Is that okay? Yeah, that's okay. Are some people going to be both 65, or could we be talking about someone who's 67 and married to a 55-year-old? Yeah, we could be talking about that. Is that okay? Yeah, that's okay. Could we be talking about the husband that has the pension or the wife that has the pension? We could be talking about either. Is that okay? Yeah, that's okay. Are any of those things going to be stumbling blocks? No. Is it going to change what product I use or what payout I use, or even if I'm going to use IUL versus annuity, what presentation I use? Yeah, it's going to change all of that. But am I going to make a sale? Yeah, if, and that's really the purpose of this call, if they agree that they can't have all their money in the market, they have to have something safe, and they're not just going to move to an annuity just because they think they have to have money in safe things. That's what you have to get. Just because people want safety doesn't mean they're excited about annuities. It's our job to get people who want safe things. It's our job to get them to realize that we don't want all our money in the market. Now, that's not a hard job. Most people are going to tell you, we're not wild and crazy aggressive. We're moderate. We don't think we should have all of our money in the market. That's not hard. When they tell you they want something safe, what takes some skill and what takes some effort is to remind ourselves that just because they want safe things doesn't mean they want the safe thing that we just tell them that we're trying to shove down their throat. We can't shove anything down anybody's throat. If you learn anything from 5Q, it's that you can't shove anything down anybody's throat. You can't tell, sell, or preach your way to anywhere or any kind of success in this industry. They have to tell you. So what is it that you're trying to get them to tell you? That annuities are great? No. Otherwise, annuities would, we started by saying annuities won't sell themselves, will they? And so sometimes I get a little frustrated because it's like, well, if we show them the single presentation or the single payout, then it'll sell itself even better. No, it won't sell itself. You can sell single, you can sell joint, you can sell annuities, you can sell IUL, as long as you show them that this isn't the only safe thing that's out there. I know that. You know that. I'm not trying to pretend that this is the only safe thing that's out here. Let's sit down together and look at all the safe things and pick the one that makes the most sense. And I know that in most environments, but especially this environment that we're in today, people are going to choose the annuity 9 times out of 10. And if they don't have an advisor, if you're replacing them as their advisor, it's practically 10 out of 10. It's even better than 9 out of 10. But I know if you don't do those things, they won't buy anything from you. And they won't work with you at all. One more question, maybe?
Nope, that's actually all the questions I have.
Okay. And so that's your atypical example. We didn't have time today. That's for somebody who doesn't want income necessarily now. We've talked about in the past, this would be your more typical example, the 67-year-old with $400,000, not $1.5 million, looking to take $16,000 per year from their portfolio, which just happens to be 4%. And what has everybody been told, or what's the mindset of everybody? That 4% is a safe withdrawal rate. And that if you just take 4%, you can even index it for inflation, and you should still be okay. Now, would that person be looking at an annuity? No, not necessarily. Not unless we show them, not unless we get them to say, can't have all our money in the market. We have to have some money in safe things. And if we look at it in context, if they're taking money now or planning to take money now, I would show them in context the sale plan to get them to say, yeah, there are other ways that we could do it, just withdrawing 4% being one, but that's not the best way. The problem with just withdrawing 4% is the markets have to cooperate. Otherwise, I have to adjust my income down in down years or suspend my income. And that's a plan, but that's not the best plan. The best plan would be something like this, where my income is reliable, predictable, and dependable, and I didn't have to worry about it, and it wasn't requiring the markets to cooperate. Whether the markets were up, down, or indifferent, I was still going to get my income, and my assets were still going to grow. So we didn't really have time to go in depth on this one. Maybe that can be another topic for another time. But I appreciate your guys' call. Again, what I want you to take away from this is that people today are all looking for safe things. And everyone will want an annuity if you can get them to tell you, we can't have all our money in the market. We have to have some of our money in safe things. And in today's world, those other safe things that you need to spend time looking at so that they can make their own decision and their own conclusions, that these other safe things have significant problems. And as a result, this annuity or this IUL looks like the best alternative. Let's go ahead and do it. And if you can do those things, you can be confident and fearless knowing that you're doing the right thing for the client. And again, if you have questions, I don't want to discourage the questions about IUL or annuity or single versus joint payout. I just want you to know that we're here to help you. But some of those things are client specific, and so call Jeff Van Grinsman, call me, and we'll help you put something together. The key is really showing it in context. If you don't divorce them from their current advisor, you're not going to get a client. If you divorce them from their current advisor, you'll get a client. And if you show safe things in context, you'll sell a lot of insurance and annuities along the way as well. All right? So again, if you have any questions about anything, Mike's gone on spring break, but we're all here all week long, and we love talking to you guys. We love working on the cases. We love mapping out strategies. That's what we're here to do, so feel free to utilize us. All right? Thanks, guys.